Eric Basmajian, founder and CEO of EPB Research. It is such an honor to finally welcome you on the show. I am absolutely delighted to have you on today. Thanks for taking the time to join me, Eric.
Thanks for the invite. I was telling you before that I'm a huge fan of the show. I think I catch every episode, including your one with Dr. Lacey Hunt, who I admire quite greatly.
I admire him too, and you're making me smile. That means so much, especially coming from you. And I'm a fan of your work as well, and I'm excited for my audience. I assume many of them probably do know you, and they follow you on social, or they watch your videos, they read your work, or if they don't, I'm just excited for them to get to know you in this conversation. And since you watch the show, Eric, you know where we always start. If that is with the big picture, that macro view, the framework in which you look at the world. And as you know, Eric, you can take all the time you need to set the table when it comes to that big picture.
Okay, and thank you again. So I'll talk for a second just about the framework that I use to try and look at the world and the economy, and then I'll try and put some numbers and some data to it to highlight where I think we are today. So I follow business cycles, primarily the U.S. business cycle, and we're all very familiar with that sine wave that represents the business cycle that we see in textbooks and charts. And what that sine wave represents is sort of the average person or average company. It's sort of a blend of the entire economy, total payrolls, total income, total consumption. But the economy doesn't really move in the same timeliness for every person or every business. There are some parts of the economy that move way before the average, and there are some parts of the economy that move way after the average. So what I try and put forward is what I would call a four economies framework. So instead of one sine wave, you can think of four individual sine waves that all sort of overlap with each other. And I call those four different economies our leading economy or leading indicators, our cyclical economy or cyclical indicators. Then we have our aggregate, which is the average. And then we have our lagging or non-cyclical component to the economy. So our leading economy or leading indicators are what most people are familiar with. And the most important thing to remember with the leading indicators or leading economy is that they don't actually measure economic activity. So we're not measuring growth or jobs in the leading economy or leading indicators. These are all commitments or monetary variables, most likely. So we're thinking about things like monetary growth, the yield curve, building permits, which represent a commitment rather than actual activity, or manufacturing new orders. So it's, again, a commitment to place an order rather than actual production activity. So that leading economy is really monetary variables and commitments, not actual economic activity. The cyclical economy is where we begin to measure actual economic activity. And here we're focused on construction and manufacturing. Those are the two interest rate sensitive sectors of the economy. They're both very capital intensive, and they have huge booms and busts. So even though people will say that those parts of the economy are shrinking, they still are the dominant force that pushes the economy into recession or creates large booms. The aggregate economy is, of course, just the blend of everything. Most people are familiar with the measures that we use for that: non-farm payrolls, personal consumption. And then the lagging or non-cyclical part of the economy is your services and parts, and healthcare, things like that don't even really contract in recessions. They're so non-cyclical that they really just they only contract if you get a really harsh contraction in the cyclical economy that pulls down the aggregate, and then it just starts to pull down sort of that lagging stuff. But some of it is so non-discretionary, it doesn't really contract. So where we are today within that framework is the leading indicators or leading economy is contracting. And it's been contracting for the better part of 2 years, which is incredibly frustrating for anyone following a business cycle process. The real difference this cycle, or the difficulty of this cycle, is those leading indicators that are still contracting today, which started contracting 2 years ago, have not yet spilled over to a full contraction in that cyclical economy yet. We hear a lot of people say that, well, manufacturing's been in a recession for 2 years and it doesn't really matter. That's not really true, because a recession is synonymous with job losses. And we don't have cumulative job losses in construction and manufacturing, despite the fact that the leading indicators, the building permits and the new orders, have been negative for so long. And the reason for that is because we built up such a huge amount of backlogs in the aftermath of the pandemic, with the stimulus response and the supply chain disruptions, that even though the construction and manufacturing sectors have experienced declining leading indicators, declining new orders, declining building permits, they've been able to sustain themselves on these backlogs where we're still building new homes that were purchased several years ago. We're still producing cars that were purchased a long time ago and restocking inventory. So without the cyclical economy contracting, the aggregate, of course, cannot, because it's not cyclical enough, which is why we've been in this sort of levitation where aggregate and lagging indicators, which is what mostly the Fed looks at, continue to post, steady, strong numbers. So what we're really waiting for here is still some of those backlogs to clear. And then ultimately that cyclical economy, those cyclical sectors of construction and manufacturing, will begin to lose some of those jobs, and that'll put some of the downstream pressure on the economy. So that's roughly where we stand today. We can get into all of that in a little bit more detail, but I'll take a break there and see where you want to go.
I love it, and I love that four economies framework. I do want to dive a bit more into more of the assessment of the economy. I feel like, Eric, I get differing pictures every time I have a conversation. It's just a different viewpoint. So if you had to step back, like, what would be more of your objective reading on the economy today?
Sure. So my objective reading on the economy today is that the economy, as I would define it, when we're answering a question like this, we'll go with the aggregate economy, because that's what, really the Fed looks at and most people look at. The economy is growing somewhere between 1.5% and 2% based on the way that I look at it. And that growth rate has been remarkably stable for the last 18 months. The growth rate is gradually decelerating, but we're talking about moving from something like 2% to 1.6% over an 18-month period. So we are gradually slowing, but we're still growing. So my overall assessment for the economy is that we are still in a slightly decelerating phase, but growth is still positive. That's enough for most of our larger mega cap companies to perform well, but it is putting pressure on some of the smaller businesses, some of the more cyclical areas of the economy. Because if the average growth rate of the economy is about 1.5 to 2, given our four economies framework, that means that our services sector is really growing at, 2 to 3%, and our more cyclical, smaller areas are probably growing in between 0 and 1. So 0 and 1 is a little bit tight, which is why we're starting to see some pressure on lower end consumers, lower end businesses. But the aggregate pie, the whole thing still looks okay. And then, of course, our services sector is doing fine, and it will continue to do fine until the economy is, outright in a recession, which is not quite the case yet.
Yeah. It's so interesting also just kind of hearing like how the four economies, like the interplay, how they impact one another. Let me ask you about, how do you discern from all of the data points the signal from the noise?
Mm-hmm. So your point about the four economies is important, and the reason it's important is because the sequence or the order in which they move, leading, cyclical, aggregate, lagging, is always the same. It's the same in every single recession or business cycle, going back to as far as we have good data, the 1960s. And it has to be the same because of the nature in which our economy is structured. The Fed is the ultimate barometer, really, of easing money and credit conditions. So if the Fed tightens money and credit conditions, that is always going to impact the interest rate and credit sensitive sectors first. It would be almost impossible for the Fed to tighten monetary policy and have, healthcare decline first. It's just, there's no relation there between why those sectors would decline. So the sequence is important. And that helps us pick up some of the signal versus noise, because we can see that, leading indicators have been declining. They still are declining, which is frustrating, but we don't lose sight of why has the economy held up, because we could just look to the next part of the sequence and see that those cyclical sectors, construction and manufacturing, are slowing down, but they're just not contracting yet. They're not losing jobs yet. So we've heard a lot of, well, the service sector is holding us up, or, fiscal spending is holding us up. We hear a lot of these things, and they've become repeated so frequently that they're almost like truth. But when we look at the actual hard data, we don't have a contraction yet in construction and manufacturing. So that's really what's going on here. The second thing that I do to try and decipher the signal from the noise is when I talk about the leading cyclical aggregate economies, I'm never just talking about one indicator. I'm talking about a basket or a collection of indicators, all which have proven to be sound indicators on their own. But any one indicator is always subject to a false signal. Building permits, for example, is a tremendous leading indicator, but even building permits have had false signals. You can look at basically any indicator that you want, and they can be 80, 90% successful, but it's almost impossible to find a 100% perfect indicator. But if you take, 5 or 6 indicators that, are all grouped in the same part of the sequence, that all have 80 or 90% success rates, and you bucket them together, and you sort of look at the way that the whole bucket or the whole collection is moving, that helps you weed out some false signals, because you might say, okay, the cyclical economy, we're tracking 6 indicators here. One of them is rising very sharply. The other 5 are contracting. I have a little bit more confidence to go with the bulk of the indicators, or the diffusion, as we would call it.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028, when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut, and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. Like you point out, there's no 100% indicator, or some of these data points, they can be false signals. I am curious about one. Let me just bring up one that came up recently. Came up on the Dr. Lacey Hunt episode, the downward revision in the non-farm payrolls jobs data. What do you make of that?
Yeah, it's a really important question. So revisions are tough, and we have to sort of embrace them. It's we can't really forecast revisions. We can do the best we can. I like to look at revisions in a couple different ways. First is that the direction of economic revisions tend to occur in the direction of economic momentum. And that's a pretty solid truth. It doesn't mean every single indicator, every single month will be revised upward or downward, but generally speaking, the economic revisions will occur in the direction of economic momentum. So when we look at non-farm payrolls, for example, we had upward benchmark revisions in 21 and 22 as we were, rocketing out of the pandemic and jobs were increasing at a very sharp pace. The economy was broadly accelerating. We had upward revisions to most of those numbers and on the benchmark revisions. Then in 2023, we've been in a period where the economy is slowly starting to decelerate. It's not contracting, but the momentum is certainly slowing, which is why the Fed has pivoted from hikes to cuts and all of these types of things. So since the direction of the economy is sort of moving downward, revisions are starting to follow and move in that direction. And the reason for that is because a lot of these economic indicators that we follow are modeled. So the government agency will sample a certain amount of data and then try and model or extrapolate it to the broader economy. And they're using a lot of linear extrapolations. And there's nothing particularly wrong with what they're doing, but it's difficult to pick up the inflection points with a model like that, which is why when the economy moves from a period of acceleration to deceleration, that revision is going to miss it to the upside and vice versa on the downside. So I tend to take some signal from the economic revisions in terms of if we're getting successive downward revisions, that's confirmation to me that the economy is in a decelerating state. Or if we're getting upward revisions, that would be confirmation that the economy is experiencing perhaps more upward momentum. But other than that, we have to sort of just embrace the revisions, kind of let them flow into the indicators, but take some signal as to the overall direction of where most of these things are moving, because there actually is some signal to the revision within all of the noise that gets reported on a monthly basis.
Got it. Okay. You also mentioned earlier, I'm just looking at my notes, that there's certain things they almost get repeated so often that they come out like they're truths or things. Right. So let me ask you this. I feel like you probably notice different, you probably see these myths, if you will. What are some of the common ones that you see that you kind of like shake your head at?
Yeah. So the one that grinds my gears a little bit is that construction and manufacturing are becoming an ever smaller share of the economy. Therefore, they don't matter. Because it's true that construction and manufacturing together are about 20 million payrolls against a total of 150 or 160. So as a percentage, it's small, and that percentage has been dramatically shrinking over the years. But the fact of the matter is that in every single recession up until 2008, excluding the COVID recession for obvious reasons, construction and manufacturing have represented more than 50% of the job losses in all of the downturns. So those sectors are so volatile that in a typical job loss recession, you may have somewhere between 2 and 4 million job losses. And almost all of those can come from construction and manufacturing because the industries by their nature are so volatile and so boom bust. So that's one that I hear a lot, and I try and refute whenever I can. And again, the reason why we haven't experienced the downturn this time is not because of the strength of the services sector. It's because the lack of the contraction in the cyclical or construction and manufacturing sectors. The second thing that I hear a lot, which I think is worth discussing for a second, is inflation. We don't often think about inflation in terms of the business cycle. And if we were to bucket inflation within those four economies, inflation would fall into the lagging or non-cyclical economy. So inflation always lags the business cycle. And this is a particular problem for the Federal Reserve most of the time, because when inflation is running high, they generally try and continue to hold a tightening policy stance. But that disregards what's happening in the leading and cyclical sectors, which move first. So inflation is always going to have its largest declines after the broader economy. So after you get job losses is when you're going to have the largest declines in inflation. For example, inflation bottomed in 2010, 11, and 12. That was when the trough in inflation was for that business cycle. Of course, the broader economy had its worst years in '08 and '09. And that's similar type of a pattern for all of the recessions going back in the past. And the reason for that is, again, because of those four economies. The services sector, the inflation in the services sector is often embedded on a contract basis. So a 12-month contract, or you think about rent for your lease. If you sign a lease today, you're not going to experience deflation, let's say, at a minimum until that lease expires. Or in the services sector, just generally, contracts are often given on a 12-month or 24-month basis. So it takes a really long time for those prices to change. Whereas commodity prices or durable goods prices like a washing machine, a dryer, those prices can change really quickly on, if a retailer has too much inventory, they'll just mark the price down tomorrow to try and get rid of the inventory. So you see those changes come up very quickly. So when we're looking at inflation today, we're in a similar standpoint where, depending on whether you're looking at core or headline, we're somewhere between 2.5% and 3% on the inflation, which still looks high, and it is high, of course. But so much of that inflation is being driven still by the more services element, like rent and insurance, where some of the earlier indicators are moving down more forcefully, like the commodities, the durable goods. So that's another one.
Okay, wait, let me just clarify then. So
Sure.
just looking at the most recent, not right now, but inflation bottom 2010, 11, 12, worst years 2008, 2009. But so we haven't seen that bottom yet. Do we need kind of like a recession or like a 2008 kind of situation for it to bottom?
So I think that inflation, I don't think that we've seen the lows in inflation for this cycle, because I don't think that the business cycle has bottomed. Now,
Gotcha.
It's possible that we can have the proverbial soft landing, where, leading indicators, the Fed cuts rates, leading indicators turn back up. We never experience any job losses. And then inflation will turn back higher with a lag to the business cycle turning back higher. But my opinion is that the business cycle is still in a decelerating phase and there's still more downward momentum. So inflation will continue to subside with a lag to that overall business cycle trending down. So generally speaking, you're always going to have core inflation lag changes. To use a more simple term, inflation will generally lag changes in employment. So, we've started to see the unemployment rate rise from its low point. It was, maybe 3.4% a year and a half ago. It's 4.1% now. It's been rising gradually. Inflation has been coming down gradually. If the unemployment rate continues to accelerate to the upside, then with a lag, you'll see inflation fall more sharply. And then conversely, if we've seen the peak in the unemployment rate and that's it, that's all we're going to see, we're starting to trend down now, then inflation will have likely started to see its low points. But my view is that the unemployment rate is going to continue trending higher. Therefore, inflation will have more downside as a result of that.
Got it. All right. Well, while we're recording this, I don't know, 25 minutes ago, the FOMC minutes for the September meeting, they just came out. A substantial majority of participants supported lowering the target range for the federal funds rate by 50 basis points. So what do you make of the Fed September rate cut? I'll just leave it a bit more open-ended, but I would love to get your take.
Yeah, this has become a huge issue now that they cut 50 basis points and then we had this really strong jobs report, and it's made their decision look quite silly in hindsight. But I don't necessarily think it was the wrong decision, and I didn't think that the 25 versus 50 basis points was that material. I thought that the more important signal from that meeting, and maybe it is a little bit more detail in the minutes, is what their projections were for 25, 26, and the longer run. And they sort of guided to the fact that they believe that the terminal rate or the quote unquote neutral rate was around, 3 or 3.5. So they guided to, like a 3.4% in 25, a 2.9% in 26, and then a 2.9% in the longer run. So call it, 3 to 3.5. I thought that was more important than the 25 or 50 basis points, because that's going to sort of influence the middle part of the Treasury curve a little more, the 5-year rate. And I think what's happening is the market is gravitating, and then the Fed is following this view that the neutral rate or the terminal rate is substantially higher than we thought it was over the last 10 or 15 years or so. I was listening actually this morning to one of your previous guests, Chris Whalen, who's a friend of the show, and he was, making the case that rates in the Fed funds in the 4% range is something that the economy can handle. And I take a little bit more of a pessimistic view. I don't believe that the neutral rate has shifted that materially post-COVID. Prior to COVID, and over the last 2 or 3 years, we broadly believed that the neutral or terminal rate was about 2.5% on the Fed funds rate. Now we're starting to believe that it's 3 or 3.5. And I think that the reason that we are collectively starting to believe that that neutral rate is higher is because the Fed did this crazy tightening campaign and we didn't have a recession, or we haven't had one yet. Therefore, we have the belief that we can handle 5% rates. But going back to what I was saying at the beginning of this conversation is that I don't believe that the economy was powering through 5% interest rates. What I believe was happening was we were generating economic activity off of the backlogs that were accumulated in 21 and 22 when interest rates were still 0 or 1%. And we have really strong evidence of this. For example, in the new construction sector, this is one of the most important things. It was on my Twitter this morning. In the new construction sector, home building companies can offer homes for sale that are under construction, not yet started, or completed. So you could buy a home from a home builder out of a booklet, let's say. It's not yet started, they haven't broken ground, but they list it as inventory. You could buy a house in the middle of construction as they're building a development, or you can buy a house when it's completed. Normally, over the past 40 or 50 years, home building companies, of their listed inventory, somewhere between 20 and 25% of it was completed at any given time. In 2022, 8% of their inventory was completed, which means that 92% of their listed inventory was either under construction or not yet started. So in my view, that means that the Fed could have raised rates to 15%, but those still had to get built. They were financed, they were purchased, but those companies still had to build those homes. And we had multiple years worth of backlogs, something I dramatically underestimated. And I think most people underestimated as well. To use one example, I have a good friend of mine that started construction on his house in 2021 and it just finished now. It was a custom built house, but that's a 3-year. So that was economic activity that was being recorded today. That was employment that was being recorded today based on economic activity that was generated in 2021. So I think we've been operating under this illusion that the economy has just been powering through these 5% interest rates, when I believe a lot of this auto production and a lot of this housing construction was really based on 2021 and 2022 levels of activity.
So 2022, only 8% was completed. So there's still 92% that still has to get completed then?
So they don't always get to 100. So like in the worst of the Great Recession, it increased to 50%. And that was like dramatic. So if it rose above 30%, that would be a lot.
Okay.
So they don't carry 100% of completed inventory, but we increased so far to 22%. So we've gone from 8 to 22. 24% is the historical average. So we're just about done with these backlogs. We finally, after 2 years, have exhausted some of these backlogs in residential construction. But again, I think that really is the critical point here was was the economy generating all this activity facing 5% interest rates, or did we have, people building multifamily apartments in 2023 and 2024 that broke ground in 2022? So now as those projects roll off, which is now what we're starting to see as these backlogs have cleared, now we're really starting to face the interest rates that are present in the economy today. And I think now is going to be the question of, can we sustain these interest rates or not? Has this neutral rate miraculously jumped 100 basis points because of a pandemic? Or are we really not in a much different place than we were prior to this? We just had a incredible shock, an incredible amount of overstimulation, and obviously some acute supply disruptions along the way.
Yeah, it makes you wonder too, like you're right. I feel like every city you go to, you see all those multifamilies going up. Interesting. Okay, this is so I love the show.
They all started in 2021 and 2022. It takes about 2 years to build those. And then the same dynamic was prevalent in the auto sector. I mean, we all know in 2021 and 2022, the economy was exploding. It was booming,
and it was so hard to get a car. I remember like I bought a car in 2021, but I remember like people were like, everybody wanted a car.
It was impossible, right? So like you could have ordered a car and it would have been delivered in a year, right? But that production gets recorded as economic activity, right? But that was kind of like a consumer decision that was made in 22.
Wild. Yeah. It's so interesting to think about. Like, again, this is why I love this show, because you're bringing up something we haven't discussed before. Okay, now that we are on the residential, can we talk maybe about the residential cycle? Let's throw housing in there as well. I want to hear more of your thoughts on this area. It's something I selfishly talk about or want to know more about, as I'm a millennial that doesn't own a home yet. I want to own a home, but what's going on in the residential cycle these days?
Yeah, it's a topic of interest for all of us, for sure. And I don't know where you live primarily.
Raleigh, North Carolina. I was in New York for a decade.
So I live in the Northeast in New York, and our housing is
I lived in New York expensive. For 10 years, moved to Miami briefly, settled in Raleigh.
Okay, so you know the expensive expensive areas. So so let's talk housing. So again, I think it's really important when we talk about housing to dial into what indicators and what part of housing are we talking about. This is another pet peeve of mine that I probably could have mentioned in that section of the conversation, where we bring up the term housing and people jumble in building permits with home sales, with construction, with home prices. And those things happen on radically different parts of the economic sequence. Building permits are more of a leading indicator. Construction is more in that cyclical part of the economy, and home prices are really more synonymous with inflation, because it's like home price inflation. So that's more of like a lagging type indicator. Home prices kind of lag the business cycle, lag the employment cycle. So where are we in that cycle? So we know we have a downturn in building permits. We know that the residential construction is slowing down. And we don't yet have job losses, however. And without job losses, it's really difficult to get nominal home prices down. The second thing that we have to talk about is the supply-demand dynamic in the housing sector, of course. So in the housing sector, we have new homes and we have existing homes. The inventory levels in the new construction market are starting to get somewhat elevated because they're clearing these backlogs, they're building these homes, and they're starting to come online. So we have an accumulation of inventory in the new home market. And in order to sort of clear some of that inventory and continue the cycle, we have the phenomenon of these builders buying down mortgage rates, which is effectively a price cut. But they're doing what they can to kind of keep the inventory levels from rising too much in that sector. Then we have the existing home market, which has super, super low levels of inventory, broadly speaking. And the issue for all of us prospective home buyers is that the existing home market is about 85 to 90% of the total market. So if you're going to buy a home, more often than not, it's going to be an existing home versus a new home because the volume is so much larger there. So a balanced market where there's neither huge increases in price or huge decreases in price is what we call a month's supply of about 5 to 6. Now, a month's supply means how many months will it take to clear all of the inventory out of the housing market at the current pace of sales, right? So if you have 10 homes for sale and you sell one home per month, the month supply would be 10, right? Because it would take you 10 months to sell all of those homes. So a balanced market with neither huge increases in price or decreases in price is somewhere between 5 and 6. Currently, for the entire housing market, both new and existing, we're at a month's supply of about 4.5. So we're still in the quote unquote tight national inventory phase because we're below that 5 level. But to give you an idea how crazy things were, we were at 2 during the craziness of the pandemic, which was the lowest level ever recorded, which is why prices, part of the reason why prices exploded so much. So we've increased from 2 to 4.5. 4.5 is ballpark where we were pre-COVID. So we're kind of back into like a pre-COVID situation in terms of supply and demand in the housing market, which is why prices aren't really rising too aggressively anymore. And the second thing to note with this is that the regional disparities are huge. So just because I say we have a 4.5 month supply, that's the national market. Where I am in the Northeast and in parts of the West Coast, like California, we're still at like a 2 or a 3 month supply. Super, super, super tight, no inventory at all. But Texas, Florida, some other, across the Sun Belt, that month's supply is actually creeping above that 5 to 6 level, which is why we're starting to hear about these price declines in Texas, parts of Florida, and other parts of the South, maybe like Phoenix and Las Vegas. They have a little bit more elevated month supply as well. So when we get to a 4.5 month supply, we have to remember that there are some markets that are going to be way above that. And those markets are in that realm where price declines are starting to occur. And then there are going to be some markets that are still way below that, unfortunately, like where I live and in parts of California where we're still at like a 2 or a 3. So overall, where we are in the housing market is that the inventory levels are coming up. We've increased from a 2 to a 4.5 on the month supply for the national. That trend, I believe, is going to continue because affordability is still challenged. And my previous forecast for the unemployment rate to continue rising, both of those things will put downward pressure on demand. So I think that the inventory levels in the housing market will continue to rise. That'll engulf more and more parts of the country to modest price declines, while the really historically supply constrained markets will probably still hold their price just because of the inventory situation. So that's my overall assessment of where we are with the home price situation.
I kind of hope that you're right.
Yeah, right.
Okay, so
and just to give viewers some context, that month supply number in 2008 was in between 10 and 12 for the national market. So that means that some of the markets that were in really bad shape were like 12 to 15.
Wow, yeah.
Which is why the price declines were so extreme. And I don't think it's a good base case to think that we'll return to something like that. But if we get the national month supply to, a 5.5, that means there are going to be some markets that are going to be at a 7 or 7.5, which would translate to some decent price declines. But we're still, on a national basis, we still have about a 4.5. So,
yeah. Yeah. The prices are just, where I am in Raleigh, they are crazy. So I'm just kind of like hoping for a little bit of decline. I don't want to go all out.
And we really screwed up with the pandemic response, and that huge increase in home prices is synonymous with the huge increase in inflation that we've had. And this goes back to that concept of, price level versus inflation. When we talk about inflation, that like the growth rate of the price level is coming down. And I would expect that to continue coming down. But in order to get the level to come down, you need deflation or negative CPI. So home price growth has obviously moderated a lot. It was up at 20% year over year, and it's come down to flat to down in some areas, and modestly positive in other areas. So I think that overall trend will continue, but I think it's going to be it's almost impossible to have like a 20 or 30% reset in home prices which would get us back to because that would equate to like 20 or 30% deflation, which we've really never had.
Yeah, we'd probably be in a mess if we did, right?
Yeah, I think there would be an untenable situation with, because banks hold a lot of these assets, they would be all underwater, create sort of I don't think, that's possible. I mean, of course, we had this very large price decline in 2008. I do think home prices will ease off as the unemployment rate goes up and as these inventory levels go up. But I wouldn't be expecting like a 20% national home decline. I do think that the price declines, by the way, in the new home market, the new construction market, will be more than the existing home market, because once these backlogs clear, we'll have some overbuilding in some of these areas. So home builders, prevailing mortgage rates are about 6 or 6.5, and builders are buying these mortgages into the 4s in some cases, which is tantamount to something like a 15 or 20% price reduction. So you could see rather large price declines in some pockets of the country that have a lot of new construction overbuilding. But that's a very tiny segment of the market because, like we said, not a lot of parts of the country have a lot of new construction, and new construction is a subset of the overall housing market.
Yeah. Okay. You mentioned the unemployment rate. Do you have a forecast there, like a number, or is it more like directionally seeing it go higher?
Yeah.
What's your forecast?
So most of my forecasts are directional. It's super difficult to do the pinpoint, especially when we're talking about like 3 or 4 quarters into the future, which is a lens that you can use with some of this sequential process. It's a little bit difficult to get further out than that, but I do believe that the unemployment rate will continue to rise. So a lot of these leading indicators of employment that we use started to contract in the summer of 2022 and towards the end of 2022. And then the unemployment rate, although it seems like a long time ago, actually did bottom in January of 2023. So the gap between when the leading employment indicators started to contract, things like hours worked, things like job openings, things like some consumer sentiment surveys of like job, what's your assessment of the labor market, as well as things like temporary help labor. All of these things really started to decline in 2022. Then the unemployment rate did bottom in January of 2023, and it has been increasing for the last year and a half, but that increase has been really slow. It's only gone from 3.4 to, it was 4.3, now it's 4.1. So my view of the unemployment rate is that those leading indicators of employment are still contracting. We're still losing temporary help jobs. In this last employment report, even though it was a strong unemployment report in terms of the payroll gains and the decline in the unemployment rate, we lost temporary help jobs. We lost trucking jobs. We lost manufacturing jobs. We lost a lot of the deeper cyclical jobs. That is evidence that cyclical economy that we're talking about is still, feeling the restraint of monetary policy. So because these leading indicators are still pointing down, and we are seeing the weakness in some of the cyclical pockets of this labor market, my view is that the unemployment rate will continue to rise over the next several quarters. I do think that we breach the 4.5% level on the unemployment rate, but I don't have a point forecast beyond that to say, 4.75 or something like this. I think that we do breach that 4.5% level, which will motivate the Fed, in my view, to revise some of their forecasts lower than what they put on their latest SEP, which, as we talked about, was cutting rates to somewhere between that 3 to 3.5% range. Should the unemployment rate rise above 4.5%, they would probably start to revise those numbers down to the 2.5 to 3 range. That's my view of ultimately what will happen over the next several quarters.
Yeah. Do you think it's fair to say, like, for the most part, like we've kind of talked about more of the near term. I know you also look at long term. I would love to just kind of put a question to you about maybe more of your longer term outlook.
Mhm.
What factors do you look at? Do you look at things like demographics? Do you look at like our debt situation in the US? Like how do you think about like our longer term picture?
Yeah, I'm so glad you asked about that. That's my favorite conversation, just because it's something I'm more passionate about in terms of these structural problems that are impacting the economy and things that all of us as parts of the economy, we don't feel them on a day-to-day basis, but when we look back over 10 years, we feel them more aggressively. So the things that I mainly look at for the longer term view are aggregate debt levels and demographics, as you mentioned. So I'm looking at debt levels both on the public side as well as the private side. I'm looking at one thing that I'm not trying to get into a political conversation when I say this, but the relative size of government. So when I talk about the size of government, I'm looking at the total government expenditures as a percentage of GDP, sort of this most objective way I can try and measure it. I'm not looking at the deficit. I'm looking at the total expenditures. So in 2024, the total government, state, local, and federal, is spending about $10 trillion. That's the total outlays. We collect some taxes, and then the difference is the deficit. But total raw outlays of what they're spending is $10 trillion. That represents about 35% of nominal GDP. So I believe that it's accurate to say that the government is about 1/3 of the economy. The size of the government is about 1/3 of the economy. That has increased from the 1960s from about 22%. So the government was in between, 20 to 25% in the 1960s. Now we're at 35%. So the size of the government has increased quite dramatically. And my view is that has slowed the productivity gains of the private sector as the government has sort of grown into more and more industries. The government has, obviously moved largely into healthcare space. The government has moved to a large extent into the housing sector. So the government has sort of moved into more and more parts of the economy, which in my view has slowed the productivity gains of the private sector down. And that's what we're all feeling is most of us are in the private sector, and we derive our feeling of the standard of living from our inflation-adjusted income growth. And I just want to dig into that point for a second.
Yeah, go for it.
When someone's inflation-adjusted income is going up at, let's say, 3% per annum, and then that growth rate slows to 1.5% per annum, they are still moving in the right direction. They're still having an increase in their standard of living because it's going up 1.5%. But the delta between what they were used to experiencing, an increase of 3, is now an increase of 1.5. And we all feel that relative shift of, I am moving forward, but I'm not moving forward as fast as I was maybe 5 years ago or 10 years ago. So for the overall economy, when we look at the private sector, and the measure that I like to use, which everyone can look up, is real personal income x transfer payments. So that's essentially private sector income. So real income excluding what the government sends people in the form of Social Security and various other types of programs. So real private sector income. And when we look at the 20-year long-term, this is really long-term. We were talking about quarters before. Now I'm talking about the 20-year growth rate. And that's important because that represents the bulk of someone's working experience, right?
Yeah, that is literally the millennials, like our career into retirement, basically. Yeah.
Exactly. So
yeah.
In the 1960s and 70s, we had about 3% real private sector income growth for the whole economy. Now, again, that's an average. So some people are at 5, some people are at 1, but the average was 3, right? that 20-year growth rate has fallen really dramatically. And this is obviously work that Dr. Lacey Hunt has sort of highlighted in really unbelievable ways. That growth rate for the whole economy has slowed to about 1.5%. So the average person is now experiencing about a 1.5% growth rate in their private sector real income over the last 20 years, whereas the economy was generating about 3%. So that's a big difference. The second really important point is that, again, it's an average. So if 1.5% is the average, that means there are some people that are at 3.5%, but that means now some people are now negative. So now for the first time, we're starting to push segments of our population into an outright decline in their standard of living, which is something that's really, 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 it's sad. It's scary, because as humans, we can tolerate moving forward at a slower pace. We don't like it. We can feel it. But moving backwards is really, really, really difficult to tolerate. And if the average for the whole economy is now 1.5%, and we know that there's a distribution, that means that there are more and more people getting pushed below that zero bound into a declining standard of living situation. And I think that that's responsible for a lot of the, societal pressures, I guess, that we all feel and are starting to sort of observe more forcefully.
Oh, wow. This is so fascinating. Okay, let me just ask a little bit more here. So right now, I'm just looking at the notes here. We're at 35% of the GDP right now from the government.
Yep.
All right. So it almost seems like would you say that this is a consequence of us moving in that direction? Like it's
I think that the two are very interrelated. There's a study that there was a study pointed out by, I believe it was two Harvard economists, that tried to decipher the impact of government size. And their research suggested that a 10 percentage point increase in government size reduces private sector growth by 1%. Mm-hmm. So if the government moved from 20% to 30%, a 10% increase, then private sector would move a 1% growth rate down. And it roughly lines up with those numbers that I outlined, in the sense that government has gone from about, 22% or 20% or thereabouts to 34, 35%. So call it, 12 to 15 percentage point increase. And that private sector income number that I was quoting, that 20-year really long-term growth rate, has moved from about 3 to 1.5. So we've lost about 1.5 points there. And the problem that we face, and I think this is something that the prior guest I mentioned, Chris Whalen, probably would agree with me on, is that the problem that we face here is that those numbers are going to get larger by function primarily of the Social Security, Medicare, Medicaid programs, as well as maybe some other things like interest on debt, but primarily those three programs. And as our demographics age, those programs will get larger and larger. So the government is now redistributing, and I use that word maybe not as carefully as I should have, because I know it's a hot political word, but by redistribute, I just mean that the government is allocating $10 trillion in some form or fashion. We're taxing some of it back. We're borrowing the rest of it, but they're spending $10 trillion. That number is going to keep increasing. And in my view, it's going to increase faster than GDP. So we're going to be in a situation where maybe 10 years from now, instead of 35%, we're at 40 or 41 or 42. And that's almost a certainty unless we address those major programs, which I don't think there's certainly no conversations about that at the moment.
Wait, so we could get to, repeat, did you say 40? We could get to 42?
Yeah, those numbers will continue to rise, because, the bulk of those outlays are really coming from the major,
right.
And we know those programs are going to swell dramatically as the population ages. Now, as more of the boomers roll into the roll into the demographic where they're receiving the Social Security and Medicare most dominantly. So those numbers are gonna increase quite rapidly. So we'll be in a situation where we're definitely moving up, and if we're at 35% now,
right.
we're going to be moving higher. Some of our European countries are over that 50% threshold, which kind of makes you wonder, like, I guess at that point, you're kind of technically less free market than you are government derived market. But that's, and look, I know that everything I said may make it sound like I'm in favor of like no government at all or anything like that. That's not the case. I really should mention that in that paper that I cited,
was it Reinhardt and Rogoff by any chance?
It wasn't Reinhardt and Rogoff.
Oh, no.
It was Berg and Henriksen, I believe.
Okay.
It was Berg and Henriksen. It's called it's called something about the effects of government size.
Okay.
It was Berg and Henriksen. I can send it to you. We can put it in the notes. They did also say, though, something I should mention is that there is sort of a parabola type relationship where zero government is bad for growth because anarchy is not good either.
Yeah.
Right. So as the government grows from 0 to 5 to 10 and they centralize some control, they provide some laws, some services, some things like that, that's very beneficial to the economy. What we all try and figure out, and economists try and figure it out, but then it's never actually implemented in the political sphere, is where's kind of the optimal point on that curve? Where's the point where a certain amount of government is very, very helpful for society and conducive to better economic outcomes, to the point where it becomes overbearing and overburdensome. And I think that we have clear evidence that where we are now at this 30 to 35% level is too much, and that's having negative impacts on overall economic, long-term economic growth. So I personally believe from the work that I've done, somewhere in the vicinity of 20 to 25% is kind of optimal.
Nice.
But that's obviously up for debate. And it also totally depends as a society what we're trying to optimize. Like, are we trying to optimize the maximum economic growth, which we all assume we are in these economists and market conversations? We're all like, the only goal is maximum economic growth, and maybe that should be our goal. But then there's also some people that have reasonable opinions of we should, sort of blunt the extremes as well. And as a society, that's a reasonable conversation to have. So I think it depends what we're trying to optimize for. And that's sort of where I got my numbers from, but those will depend on what you think we should be doing. But there's clearly a relationship between the size and the growth outcomes, which I think is a conversation that I wish was more open in the public, but it's not.
Well, I feel like we almost need to do like another episode on this topic. Maybe we should invite Dr. Hunt on as part of it too.
That would be so cool.
That would be so cool. Epic conversation. I feel like we should totally do that. Maybe he'll be up for it.
That would be so cool. You have the power to make it happen.
I don't know. I'll ask him. But he sometimes listens to the show, so you never know. We have a guest coming on soon that he's written in about. So, Dr. Hunt, if you're listening, we would love to have you. You're always welcome on the show. We respect and admire you so much. And it does make me a little bit nervous about the future of our country, or maybe capitalism, like our capitalistic system, if we go in that direction, Eric.
Yeah, and I'll open up another can of worms that maybe we'll have to close on another podcast. But this is, again, something that I'm quite passionate about, just because I feel like it affects the country so much. I believe that there is a really tight link, although it may not be clear at first, between the rising home prices and the deterioration in demographics. So I believe what has happened to Japan, Europe, we're starting to see it now in China, we see it in Canada, and we see it in the US, is that as the government size grows larger, that government tends to protect asset values, mainly home prices. I truly don't believe they care as much about stock prices. I believe they care a lot about real estate prices, only for the sake of that the banking sector holds the debt on real estate assets. And if those decline sharply in value, you bring in a banking issue, which no one really wants to deal with. So as home prices in these countries have outpaced incomes, it's delayed household formation, where people are getting married later and having kids later. And that's causing families to have less kids. We used to have 3, then we have 2, and I think the latest numbers are 1.6. That's below the replacement rate, which means that the population at some point will start to crest and turn down. And we see, Japan has a negative population growth rate. China is now experiencing negative population. A lot of that, in my view, well, they obviously had the one China policy or one child policy, but they also had this insane home price situation as well. A lot of parts of Europe have gone down the same road, Canada and the US. So there's this really nasty connection between protecting home prices because we don't want to experience a fall in the value of those assets and bring in banks into the question. But and that feels good because the demographic situation takes so long. But as home prices rise faster than the incomes of the 25 to 35-year-old population, that's caused a really significant delay in household formation. It's caused a reduction in the overall birth rate. And that's really crippled the demographics of all the major developed countries. And, people in our age cohort, I'm sure you have friends that have been married later, have had kids later, and a lot of them have had no kids at all, which is, a difference of what it was 20 or 30 years ago.
Yep, I'm one of them. Yeah,
40
certainly.
or 50 years ago, where, you were able to sort of, have a house on one person's income and a job that you were able to acquire at, 25 years old. So it's a big difference, and I think that's a really important discussion to have. But unfortunately, our politics today are still predicated around kind of boosting the demand of home prices, something that Chris Whalen mentioned in your conversation this morning, which kind of reinforces these problems.
Yeah. I have to say, Eric, I have loved having you on the show. I would love to get you back on if you're ever open to it. You were absolutely wonderful and so interesting. I want to give you the final few minutes. I know we're actually past time, but anything that you want to say, closing thoughts, let folks know where they can find your work, your research. The floor is all yours.
Oh, thank you so much. It was an awesome conversation. I feel like I rambled too much when
you did not. No,
when I get on topics that
we love it,
that I find very interesting. No, I think we covered so much. I'd love to come back on anytime you're willing to have me. People can find me on Twitter at EPB Research. I'm on Substack. I publish some work for free there. And you could also search for me on YouTube. So all of the main platforms, you either search my name, Eric Basmajian, or EPB Research, and I should pop up wherever you are.
I love it. Eric Basmajian, founder and CEO of EPB Research. Thank you so much for being so generous with your time, all of your knowledge, your ideas. Really appreciate you taking the time. Be well and see you next time.
Thanks so much.